Ever think about how the wealthy extract money from everyone else? Probably the most important way they do this is by charging interest. If you don't quite know how interest works, like most of us, don't worry. In this video, I'll explain the basics. Hopefully, you'll find it interesting. Let's start by saying what interest actually is. It is an amount of money due per period of time as a proportion of an amount loaned, borrowed, or deposited. This contains a number of more or less obvious points. First, interest is money. It's not normally measured in other things. This means when interest is paid, it forms what is known as a cash flow. Second, the payment of interest always follows from another transaction, which means that it relates to an amount of money or something else that is held for a period of time. Third, whether interest is good or bad for you depends on your role in the transaction. Taking the viewpoint of the lender, you'll normally want the interest to be large. If you're a borrower, you'll normally want the interest to be small. Before we go into the details, it's worth thinking about why interest is so important for our everyday lives and, dare I say, for how society works. Interest is important because it is what is extracted by one person in exchange for making something else available for a period of time to another person. As such, it isn't earned. It is extracted in exchange for limited access to something else and all the risk and uncertainty that goes along with that. Most people pay interest and also receive small amounts of interest in their everyday lives, such as the interest you're charged on your student loan or the interest you receive from your bank. Think about it. Extracting value for yourself through interest means getting ahead financially through ownership and without actual work. Being able to cover your daily expenses from this sort of thing is one of the main things setting apart the rich from ordinary people. But to really make sense of this, we need a few more concepts. Let's start with a principal, also called the principal sum of money. This is the sum of money that has been either loaned, borrowed, or deposited. When thinking about interest, it's always good to start with the principal. The next thing we need to know is how much interest is charged over a standard time period. This is the interest rate that most people are familiar with. The interest rate is typically expressed as a percentage of the principal charged per year. This is what people normally mean when they say 5% or 10% interest. This means that 1/20th or 1/10th of the principal is due as interest per year. Then, obviously, we need to know the duration of the loan. This is the specific period over which the interest arises, normally ending when the principal has been returned. If this period is long, there will be more interest at a given interest rate. If it is short, there will be less interest. The duration of a loan is also known as its maturity. Surely this information is enough to calculate the actual amount of interest charged, right? Right? Sadly, no. Except in very simple cases, which you probably won't see in real life, it's not possible to fully understand how much the overall interest, as a sum of money, will be just by knowing the principal, the interest rate, and the duration. You'll need to know other things often hidden in the small print of credit agreements, such as if the interest is simple or compounding, what the payment frequency and the compounding frequency are, and if you're looking at lump sum repayment or at repayment in scheduled installments. Okay, enough financial information for now. I'll explain how all of this works in the next video. Stay tuned. This educational clip has dealt with financial topics. Please note that none of the information presented in this video is financial advice.